Good morning, everyone, and welcome back to Morning Markets today. A couple of things that I wanted to discuss this morning. The start of a new month, start of a new quarter. Rather subdued start to equity markets, particularly when we look at those markets in the UK and Europe yesterday, with both Euro Stoxx 50 and the FTSE 100 falling about 20 basis points over the course of the day. Rolling then into the US, we had a slightly stronger performance from US equity markets yesterday, with both the S&P up 50 basis points and Nasdaq up close to 1%. The difference in the markets was primarily a result of the PMI data that we saw out of the US during the US market time. And what did that show? It came in with a reading above 50, it came in with a reading at 52.6, and crucially within that, the majority of respondents given that number were indicating an expansion in economic activity. And when we look across the various sectors that survey captures, the majority that were surveyed were also indicating an expansion in their activity. So that was a positive, and potentially does show that as lockdowns easing, the economy is returning to a more normal footing. I think the other thing that helped in the case of the US market yesterday was around one of the factors that we've been discussing that is important to asset market performance over the past number of months, and that was in relation to COVID-19. And whilst in the US we continue to see rising infection rates, we also heard yesterday from Pfizer and one of their partners, as they're going through the vaccine analysis process, they give some positive updates on the work that they're doing, and that did help equity markets as a result. With that slightly more positive backdrop for equity markets, we did see a small back up in yields in the US and also in UK gilts, where UK 10-year gilts backed up to about 21 basis points, and in the 10-year in the US at 0.68. Also, just looking overnight, what have we continued to see? We've seen some of the continuation of the trend we've talked about over the past number of weeks of dollar weakness relative to broad basket of its trading partners. And that's just something that I think we've continued to focus on, and it's been an important factor for the market over the past couple of weeks, where we have seen then a degree of euro strength, and that has been maintained, and we've seen a bit of a positive move in sterling over the past 24 hours. Nothing significant, but a positive move nonetheless relative to the dollar. I think the other thing that I wanted to touch on today was that we've talked in the past about yield curve control and what that may or may not mean for various different markets. And one of the key areas that we've discussed that is in relation to the US. And what is yield curve control? At its very simplest, it's where the central bank decides to explicitly target a particular yield level, or to cap a particular yield level across the curve. So they may say that they're going to target a particular yield level at the 10-year, longer term or shorter term. But what does that mean? It means they will effectively work to keep yields at that level and or control the shape of the yield curve as a result of that. Now, in the US, that's something that has been quite topical and quite a topical discussion amongst market participants, and we were waiting to see how that was going to translate into what the FOMC or the Fed were discussing in their meeting. We got the minutes from the June meeting, and indeed the members did discuss it, but at this point in time they don't see the need to move forward with that type of strategy. They believe that being more explicit in terms of the guidance that they give to market participants, and also the use of the dot plot, which shows how the board members think about the trajectory of interest rates, is an important signalling mechanism, and they believe that better communication is the best way to deal with that problem or that situation, as opposed to being explicit with the targeting of the yield curve. So that's an interesting development, and again it speaks into just the ongoing discussion, the ongoing analysis that central banks globally are having to think about at this point in time. So that's something that we'll continue to monitor, to continue to observe, and also think about what does that mean for the Bank of England and their discussions. Turning then to the Bank of England, over the past couple of days we have had a number of speeches from MPC members. Firstly from Andy Haldean, the Bank of England's chief economist, and if we cast our minds back to the most recent vote, he was the one dissenter against increasing the QE programme. And then we heard from Jonathan Haskell yesterday, an independent member of the MPC, and his interpretation of the similar data, or the same data even, is slightly different than that of Andy Haldane. And he, whilst acknowledging that the situation has improved slightly better than in the original forecast from the Bank of England, remains concerned about the trajectory of the economy, and particularly what happens in the jobs market over the coming months. So it's just interesting, I think, to observe the difference in views, which is really healthy within the MPC, and it just gives us an indication of the type and the quality of the debate that's being had as the MPC try to navigate their way through the current situation. So that I thought was interesting and worth sharing. That's it from me today. Please join us again tomorrow. Many thanks.